we'll begin talking about Form 4797, Sales of Business Property. Now, hopefully, the only time in your tax preparation career or office that you should encounter this form is if a client sells a piece of residential rental property. The gain on the sale of the rental house is reported on Form 4797, which flows to Schedule D. Residential rental property is considered Section 1250 property, which is entered on Part 3 of Form 4797. Section 1250 property is generally property that's been depreciated over a period of years. The gain that's calculated in Part 3 then transfers back over to Part 1 of Form 4797. The gain reported in Part 1 will then transfer to Schedule D as a long-term capital gain, and you recall we discussed long-term capital gains in the last module. So, I sell my rental property, I report the cost, the sales price, and the depreciation that I've taken over the years on Form 4797. Now, I know we haven't discussed depreciation on rental property yet, but just hang with us and we'll talk about this in a later module. The 4797 transfers the gain onto Schedule D. Then, the gain on Schedule D transfers to Form 1040 and again is typically taxed at the capital gain tax rates. For example, Mr. Amendola sold his rental property for $210,000. The original cost of the rental property was $150,000. Depreciation deduction of $12,300 was taken over the years that he rented the property. His gain on the sale of the property for income purposes is $72,300, which is $210,000 minus the $150,000 that he paid for the rental property. The $210,000 was what he sold it for, plus he has to recapture that $12,300 worth of depreciation that he took over the years, making his total, his gain on the sale of the property for income purposes, $72,300. That's where we get that figure. So again, he must recapture the $12,300 depreciation that he took earlier as a deduction on the rental property. The gain is then reported on Schedule D, and then the gain is reported on Form 1040, line 13. Next, let's talk about IRA distributions and pensions and annuities. This is Form 1040, lines 15 and 16. Retirement plans are funded by either before-tax or after-tax contributions. Before-tax contributions mean the employee did not pay taxes on the money at the time that it was contributed. After-tax, meanwhile, means that the employee paid taxes on the money when it was contributed. The funding status determines if the distribution from the retirement plan is taxable. If the taxpayer didn't contribute to the retirement plan, then all of the distributions, when the taxpayer starts pulling out money from the retirement plan, are fully taxable. If the taxpayer made all the contributions to a plan with before-tax dollars, then again, the entire distribution is fully taxable. However, if the taxpayer made all contributions to a plan with after-tax dollars, then the distributions will be partially taxable. So what's the difference between distributions? We've heard the term Roth and traditional IRAs before. So what's the difference between distributions from a Roth IRA and a traditional IRA. Well, Roth IRA distributions are generally tax-free because the contributions were made with after-tax dollars. Traditional IRA distributions may be fully or partially taxable because the contributions may have been deductible, or some of them may have been non-deductible at the time that the money was contributed to the plan. A 1099-R statement reports the distributions from the various retirement plans. Now, what you would do in preparing the tax return is separate the 1099-R statements into two piles: those received from an IRA and those received from a pension or annuity plan. We report IRA distributions on the 1040 on line 15, and we report pension and annuity distributions on 1040 line 16. Now, on the 1099-R, there are distribution codes that appear in box 7. Now, let's take a look at the distribution code on the 1099-R. The distribution codes can be found by flipping over the 1099-R statement, and these distribution codes are often listed on the back of the 1099-R form. And again, we see that the distribution codes appear in box 7. So the ones that we want to highlight, the ones that are typical, are code 1, an early distribution, and code 7, a normal distribution. So if we were to enter the 1099-R information into Jack London's tax return at a 1099-R distribution code 7, which is a normal IRA distribution, shows up on line 15B, taxable amount $34,500. Now, in the next example, David Hilton left his old job. He was hired at a new job, and he rolled over his 401k retirement plan from the old job into the new job's 401k plan. He received a 1099-R form in the mail, which looked something like this. And the distribution code on this 1099-R in box 7 is the letter G. Notice in box 2A, there's no taxable amount. The gross distribution in box 1 is $22,300, but in box 2A, the taxable amount is blank. So if we flip over the 1099-R statement, we see here code G indicates a direct rollover of a distribution. So in David Hilton's 1040 form, we see on line 16A the word rollover out to the left of the line. 16A has the amount, the gross distribution of $22,300, but on line 16B, there's no taxable amount. He rolled over his distribution from one retirement plan into another. Now in this example, Jeff Walden, he lives on Arlington Road in Evans, Georgia. He has a 12-year-old son named Scott who has lived with him all year, and Jeff provides for all of Scott's support. So chances are, in this particular case, if you remember back from one of our earlier modules, Jeff is probably going to file as head of household. In 2016, Jeff left his old job and he was hired at a new job. He withdrew all of the funds from his old job's 401k retirement plan. He didn't roll over the funds from this 401k from the old job. He simply used the money in order to pay off some personal debt. So when he opened his mailbox, he received a W-2 from work and a 1099-R from his old job's pension plan. Here's his 1099-R that he received from his former job. We notice in box 1, gross distribution $16,500, taxable amount in box 2A of $16,500, and like we said, in box 7, distribution code 1 indicating an early distribution. So if we flip the 1099-R on the back, we see in box 7, code 1, early distribution, no known exception. Well, his 1099-R taxable amount transfers to line 16B of the 1040, and it adds to his total income. Because of the distribution code 1 on the 1099-R indicating an early distribution of his 401k retirement funds, Jeff has to fill out an additional form on his tax return. Form 5329. This is what the no known exception refers to, an exception to this form, Form 5329. Here's Jeff's Form 5329, and we see on line 4 there's an additional tax that's been calculated, 10% of the distribution. In Jeff's case, $1,650. And we include this amount on Form 1040, line 59. So in Jeff's case, he's got some additional tax that he has to pay on his tax return, 10% of the distribution that he took out, because he took the distribution out to pay personal debt. In some cases, early withdrawal from a retirement plan will be exempt from this 10% penalty. In Jeff's case, because he used the funds to pay off his personal debt, his withdrawal from his 401k doesn't qualify for any penalty exclusion. Below are listed some of the reasons why Jeff might qualify for an exclusion from the 10% penalty due to an early withdrawal from his 401k retirement plan. Most often you might see something like number 8, made for higher education expenses. This applies only to IRAs. Number 9, made for first-time home purchases up to $10,000. Again, this only applies to IRAs. Number 5, due to the extent that you have medical expenses. And again, these are some of the reasons that would qualify for an exclusion from the 10% penalty because of an early withdrawal from a retirement plan. So, in summary, the gain on the sale of rental property is reported on Form 4797 and Schedule D. Retirement plans are funded by either before-tax or after-tax contributions. Before-tax dollars means that the employee did not pay taxes on the money at the time that it was contributed. After-tax contributions means that the employee paid taxes on the money when it was contributed. Retirement distributions are generally reported on Form 1099-R. Form 1099-R, Box 7, lists the distribution codes that will affect how the retirement distributions are reported on the tax return and whether or not there will be any additional tax paid on the distribution. And Form 5329 reports the 10% additional tax on early distributions from a retirement account. And now let's take a look at some review questions.